China's manufacturing sector lost momentum in May, with new orders shrinking and price pressures falling further, providing fuel for disinflation both at home and abroad. The Caixin manufacturing PMI tumbled to 48.3, the weakest level since September of 2022. Markets had expected a reading of 50.6, stronger than a month earlier. New orders fell sharply, and export orders dropped even faster, marking a second straight monthly decline. That's troubling for a sector that continues to rely on external demand to offset soft domestic conditions. Making the case for both fiscal and monetary easing, we're now seeing clear evidence of internal disinflation. Input costs dropped for a third straight month, driven by lower raw material and energy prices. Selling prices also fell as firms cut charters to stay competitive, intensifying the squeeze on margins. The disinflationary pulse raises questions as to whether China could start exporting deflation again, adding to the risk that major central banks may have to cut policy rates beyond neutral levels to bolster demand. The Caixin survey, following a similar result from the government's official PMI released last weekend, provides a timely reminder that the US is not the only economy vulnerable to trade tensions. The longer they persist, the greater the risk that increased uncertainty will start to weigh on hiring, investment, and confidence, increasing the risk of a global downturn.